Trade, aggression, and comparative advantage bidding in an evolutionary monetary system. The purpose of an evolutionary monetary system is to allocate resources optimally toward production. Money, prices, and profit exist to guide capital toward the individuals capable of generating the greatest increase in productive output. In such a system, profit is not merely a private reward. It measures the productivity gain created by allocating resources to one use rather than another. Many anarcho-capitalists misunderstand this function of markets. They often argue that trade is always more profitable than aggression because voluntary exchange benefits both parties while aggression destroys resources. From this perspective, rational actors in a purely market society would always prefer trade over conflict. This claim is incorrect. Trade can be more profitable than aggression, but it is not necessarily so. The profitability of either action depends on whether transferring control of an asset increases production. If a challenger can generate greater productive output from a piece of capital than the current owner, then reallocating the asset increases total production. Under those conditions, aggression may be privately profitable if the productivity gain exceeds the cost required to remove the current owner. The central issue in property disputes is therefore not the method of transfer, but the productivity of the allocation. To understand this properly, we must examine economic profit and opportunity cost. Production can be defined as accounting profit, revenue minus explicit costs. Economic profit equals production minus opportunity cost, where opportunity cost represents the value of the next best use of the resources involved. In an evolutionary monetary system, economic profit, therefore, measures the increase in production that results from allocating resources to one activity rather than another. Ownership of capital is economically stable only when the current owner can generate at least as much economic profit from the asset as any alternative user. If another individual can generate greater economic profit from controlling the capital, then the asset is misallocated. In such a situation, the challenger has an incentive to obtain control of the asset. However, rational actors prefer to avoid unnecessary costs. Conflict consumes resources through defense expenditures, delay, and disruption of production. These costs reduce the productivity gain from reallocating the asset. For this reason, negotiation naturally emerges in market environments. Negotiation is governed by opportunity costs. The current owner can abandon the asset and move to another productive activity. The value of that alternative defines the minimum compensation required to induce the owner to relinquish the asset. Likewise, the challenger has alternative uses for their resources if they do not acquire the asset. The value of those alternatives defines the maximum amount the challenger can rationally offer. These opportunity costs create the natural arbitration bounds of negotiation. The challenger needs only to compensate the owner enough to move the owner to the owner's next best opportunity. The challenger does not need to transfer the full productivity gain that the challenger expects to generate from the asset. The difference between these values represents the productivity surplus created by reallocating the capital to a more productive user. However, negotiation often fails because the parties lack reliable information about comparative productivity. Each participant may believe that they are the more productive user of the capital. The comparative advantage bidding system addresses this information problem. In this system, participants submit bids representing the productive output they expect to generate if they control the asset. A bid therefore communicates expected productivity with the capital, not profit and not cost. Because each bidder reveals the production they expect to achieve, the bidding process creates a ranking of productive capabilities. However, absolute productivity alone does not determine the optimal allocation of capital. Each bidder also has opportunity costs, the productive output they could generate by using their resources elsewhere. The relevant measure for determining the optimal owner is therefore net productivity gain. Net productivity gain equals the production a bidder expects to generate with the asset minus the production they could generate without it. The optimal owner is the individual whose control of the asset produces the greatest net increase in production relative to their next best alternative. This is the principle of comparative advantage. A participant capable of producing more with the asset in absolute terms may not be the optimal owner if their alternative opportunities are even more productive. The asset should instead be allocated to the user whose control of the capital produces the largest increase in total production. Comparative advantage bidding therefore reveals which allocation of the asset generates the greatest net productivity gain. Once this ordering is revealed, the market recognizes the participant with the greatest comparative advantage as the efficient user of the capital. If a lower bidder attempts to seize or defend the property against the participant identified as having the greatest comparative advantage, the system imposes a reputation burn. Reputation represents accumulated productive contribution within the system. It determines an individual's future ability to command capital and participate in economic decision-making. Destroying reputation therefore reduces an individual's future productive power. The reputation burn imposed on a violator exceeds the productivity gain that the violator could obtain from controlling the asset. As a result, violating the revealed productivity ordering produces a larger loss than any possible gain from holding the property. This mechanism preserves the integrity of the comparative advantage bidding system by ensuring that lower productivity defection becomes irrational. Another important situation arises when an owner irrationally defends property beyond its economic value. An owner may continue defending an inefficient asset even after it becomes clear that another individual could generate greater economic profit from controlling it. This behavior may persist if the owner controls other profitable assets that subsidize the defense of the inefficient property. Productive capital elsewhere is then used to finance the continued defense of lower productivity ownership. Although this cross-subsidized irrationality can temporarily preserve inefficient allocations, it reduces the owner's total productivity relative to competitors who allocate capital more efficiently. This introduces evolutionary pressure. In a pure market system, economic power evolves through differential accumulation of productive success. Agents and strategies that allocate capital to higher productivity uses accumulate greater economic profit and therefore greater economic power over time. Agents that persistently waste resources defending inefficient allocations lose relative power. The magnitude of deviation from rational allocation determines the strength of this evolutionary pressure. Small deviations produce small losses and may persist for long periods. Large deviations destroy productive capacity quickly and therefore provoke stronger correction. Over time, the system favors those strategies that allocate capital to the individuals capable of generating the greatest net productivity gain. The purpose of an evolutionary monetary system is therefore not merely to facilitate exchange. Its deeper function is to measure productivity gains and direct capital toward the uses that maximize production. Comparative advantage bidding reveals which participants can increase production the most after accounting for opportunity costs. Reputation burn penalizes attempts to obstruct this productive allocation. Evolutionary pressure then eliminates persistent deviations from efficient use. The fundamental principle is therefore simple. Capital tends to move toward the users whose control of it produces the greatest increase in total production. An evolutionary monetary system exists to discover those users and ensure that resources flow toward them.